Welcome back to the channel. Today we're diving into one of the boldest claims making the rounds in the crypto world right now. The idea that Bitcoin's current bull run won't just be another cycle that peaks and fades, but could actually extend all the way into the year 2027. Some analysts are even putting numbers on it, whispering about $200,000 price targets before this rally is finally exhausted. If that sounds optimistic, even outrageous, you're not alone. But what if there's more to it than just hype? What if this cycle really is different? Now, if you've been around crypto long enough, you'll know that phrase, "this time is different," gets thrown around a lot. Usually it's a warning sign. It's what people say near the top of the market, right before the crash comes. But let's not dismiss it too quickly. Bitcoin has followed a surprisingly reliable rhythm across its history, tied closely to its halving cycles. Every 4 years, the supply of new coins entering the market is cut in half. In the past, those supply shocks have triggered massive rallies, followed by brutal bear markets that last until the next halving resets the stage. Think back to the early days. In 2011, Bitcoin's price was measured in mere dollars. By 2013, after the first halving, it rocketed past 1,000 before crashing back down. In 2017, we all remember the mania when Bitcoin reached just under 20,000, only to collapse into a long winter. 2021 was the next big chapter, with Bitcoin breaking through 60,000, peaking around 69,000 before once again retracing deep into the 30s and 20,000s. Each of these runs lasted about a year or so after the halving, and then momentum collapsed. So the pattern is familiar. Halving sparks supply squeeze, bull run takes over, peak arrives within a year or so, then comes the long cold bear. By that logic, the 2024 halving should set the stage for a run that peaks in 2025, maybe early 2026 at the latest. That's how the cycle math works. But here's the twist. Analysts at Bernstein, one of the biggest names on Wall Street, are saying the 2024 to 2027 cycle might break the mold. They argue this rally could last not just a year, but 3 full years. Their target? 200,000 per coin by the time it's over. Now, why would anyone make such a claim? The obvious answer is that Bitcoin has matured. The players involved today are not the same as the ones back in 2013 or even 2017. Back then, retail dominated. Individuals on Reddit boards, Telegram groups, and crypto Twitter were the ones pumping prices and getting burned when the music stopped. Today, things look different. Institutions are here. ETFs have opened the floodgates. Pension funds, insurance companies, family offices, they now have vehicles to put serious money into Bitcoin without worrying about private keys or shady exchanges. And when that kind of capital flows in, the rhythm changes. Institutions don't trade like retail. They don't all pile in at the top and panic sell at the bottom. They scale in, they rebalance, they hold through volatility. That alone could extend the cycle. Add to that the macro backdrop. For the first time in history, Bitcoin isn't just a curiosity or a hedge against inflation. It's being discussed alongside gold, bonds, even national reserves. Governments are openly debating the idea of holding Bitcoin in their strategic asset baskets. In the United States, lawmakers have floated the concept of a strategic Bitcoin reserve. That changes perception. If sovereigns start buying, we're no longer talking about cycles driven only by halving math. We're talking about cycles driven by policy, by geopolitics, by liquidity conditions in the trillions. And let's not forget what's happening in Asia. Wealthy families and family offices across China, Singapore, Hong Kong, and South Korea are upping their crypto allocations. Reports suggest they want at least 5% of their wealth in digital assets. Imagine what that means when you're talking about billions and trillions in capital. That steady allocation flow can keep the market buoyant long after retail froth would normally burn off. But let's pause for a second, because if you're listening to this, you might be thinking, hang on, haven't we heard this before? Weren't people saying in 2021 that Bitcoin was on its way to 100,000, only for it to collapse into the 30s? And you'd be right. Optimism can run ahead of reality. In 2017, people said institutional money was just around the corner. In 2021, they said inflation would send Bitcoin to the moon. Both times, the hype was bigger than the outcome. That's the danger of believing too strongly that this time is different. So what makes this claim for 2027 more credible? First, the infrastructure is undeniably stronger now. Back in 2017, the biggest institutions barely dipped a toe in. In 2021, ETFs were still a dream. Today, ETFs are real, regulated, and trading billions in volume. The rails for institutional adoption are built. Second, the macro environment is unique. Global debt is at record levels. Interest rates are struggling to balance inflation and growth, and the dollar's dominance is being challenged in ways we haven't seen before. In that kind of world, Bitcoin's narrative as digital gold doesn't just resonate with retail, it resonates with central banks. Now, let's talk about the psychology of the market. In past cycles, retail euphoria reached unsustainable levels quickly. Everyone from your barber to your grandmother was suddenly a crypto expert. That mania always signaled the peak was near. This cycle feels different. Yes, there's hype, but it's tempered. The mainstream narrative is more cautious. Institutions are disciplined. Analysts are using valuation models, talking about allocation percentages, discussing macro hedges. That kind of environment doesn't produce the same blow-off tops. It produces grinding, extended climbs. Still, nothing is guaranteed. Skeptics say Bernstein's call is too rosy. They point out that the halving cycle is baked into Bitcoin's DNA, and it's foolish to believe one cycle can suddenly stretch 3 times longer. They argue that even if institutions are here, human psychology hasn't changed. Greed and fear still drive markets, and eventually the bubble always pops. If history is a guide, a crash will come well before 2027. But here's a thought. Maybe both sides are right. Maybe Bitcoin doesn't shoot straight to 200,000. Maybe we get smaller peaks and smaller drawdowns along the way, creating a longer, steadier climb rather than a vertical rise and violent crash. In other words, the bull market might stretch out simply because the market itself has matured. And in that scenario, 200,000 doesn't have to be mania. It could be a logical endpoint of steady adoption and capital flow. As we look at Bitcoin's current price, hovering around 112,000, the question isn't just whether we'll see new highs this cycle. It's about how the entire structure of the market is evolving. The halving will always matter. Supply shocks are baked into the code, but demand drivers are shifting. Institutions, sovereigns, family offices, they don't move on Reddit hype cycles. They move on strategy. And that shift could be the reason 2027 isn't as crazy as it sounds. So let's go deeper into the machinery that could stretch this cycle out longer than anything we've seen before. The first big factor is the rise of Bitcoin exchange-traded funds. ETFs have transformed the game. In past cycles, institutions that wanted exposure to Bitcoin had to either buy directly on exchanges or deal with over-the-counter desks, custodians, and the messiness of wallets and storage. That was enough to keep a lot of them away. But now, with spot Bitcoin ETFs trading billions in volume every single day, the friction is gone. For the first time, pension funds, sovereign wealth funds, hedge funds, and even corporate treasuries can allocate to Bitcoin in the exact same way they buy stocks or bonds. It's as simple as ticking a box. Think about the effect of that. When a new ETF launches and receives just a 1 or 2% allocation from a major pension fund, we're talking about billions of dollars flowing in at once. Those inflows don't look like retail FOMO. They look like a steady tide. And unlike retail, institutions rebalance methodically. They scale in over quarters and years, not hours and days. That kind of disciplined buying is what smooths cycles, extends rallies, and makes the parabolic crashes less likely. It's also what could drive Bitcoin to levels we haven't seen before. Now, here's where it gets even more interesting. Some analysts argue that the ETF wave is only just beginning. In the United States, we've already seen record inflows. But Europe, Asia, and the Middle East are only getting started. Hong Kong recently approved its own spot Bitcoin ETF. Singapore is debating frameworks. If Asia's wealthy family offices and sovereign funds begin to treat Bitcoin ETFs as a default allocation, the cycle could turn from a short-lived sprint into a marathon. But let's stay on Bitcoin for a moment, because the second major factor is the macroeconomic backdrop. In every past cycle, Bitcoin's price was shaped mainly by crypto-native dynamics. Retail speculation, halving cycles, exchange booms, and busts. Today, macro matters more than ever. Inflation, interest rates, dollar strength, bond yields. These are all signals traders now watch as closely as on-chain metrics. And right now, macro conditions are volatile. Global debt is at record highs, governments are under pressure to find new ways to finance spending, and the US Federal Reserve is walking a tightrope between cutting rates to support growth and holding them high to crush inflation. That's why Jerome Powell's speech at Jackson Hole matters so much. When the Fed chair steps up to the podium in Wyoming, the entire financial world hangs on every word. A hint of easing could send liquidity flooding back into risk assets, not just stocks, but crypto too. A hawkish tone, on the other hand, could stall momentum. Bitcoin is now firmly a macro asset. It trades with equities, with gold, sometimes even inversely to the dollar. That correlation means macro events could sustain this cycle longer than the halving calendar ever did. And here's another point. Unlike in past cycles, Bitcoin isn't just in the hands of retail traders anymore. It's in the hands of corporations, institutions, and even governments. When El Salvador adopted Bitcoin as legal tender, people dismissed it as a gimmick. But look around today. The idea of sovereign Bitcoin reserves is no longer fringe. Politicians in the United States have openly discussed creating a strategic Bitcoin reserve, just like the Strategic Petroleum Reserve. If that idea takes hold, it's not hard to imagine other countries following suit. Once that ball is rolling, demand doesn't just grow, it compounds. Ethereum and XRP add more color here. Ethereum is carving out its place as infrastructure for real-world assets. The rise of tokenized treasuries, corporate bonds, and even tokenized money market funds has given Ethereum an entirely new role. If Bitcoin is digital gold, Ethereum is fast becoming digital Wall Street. And when institutions build tokenized products, they need the base layer. That means steady, organic demand for Ether, regardless of short-term price moves. If Bitcoin rallies into 2027, Ethereum will likely ride the wave too, not as a speculative play but as an infrastructure bet. XRP, meanwhile, has cleared a major legal hurdle. For years, the SEC lawsuit was a cloud over Ripple and XRP. With that settled, the token has reclaimed its place as a top 3 asset by market cap. The narrative for XRP is different. It's about settlement, cross-border payments, and the possibility of banks and financial institutions integrating Ripple's technology at scale. In a world where stablecoins, central bank digital currencies, and tokenized assets are colliding, XRP could benefit from being a bridge. Its price may not explode like Bitcoin's, but in a longer, steadier cycle, XRP has room to grind higher, supported by real utility. And let's not forget Solana. This chain has had its ups and downs, outages, skepticism, questions about centralization. But in this cycle, Solana has re-emerged as the high-speed, low-cost alternative to Ethereum. Meme coins, NFTs, DeFi protocols, they all thrive on Solana's fast rails. And institutional investors are paying attention. If Bitcoin's rally extends, traders looking for higher beta plays will naturally rotate into Solana. Its performance could be volatile, but in a 3-year cycle, that volatility could produce outsized gains. All of these forces add up to a market that doesn't look like 2013 or 2017 anymore. It's deeper, more liquid, more institutional, and more global. That's why Bernstein and other analysts believe the cycle could stretch. The inflows aren't just bursts of retail euphoria anymore. They're structured, disciplined allocations from the biggest players in finance. But we also need to be realistic. Nothing goes up forever. Even if the rally stretches into 2027, it won't be a straight line. There will be pullbacks, corrections, moments of panic. The question is whether those dips become full-blown bear markets, or just pauses in a longer march upward. If institutions really are the dominant buyers now, the odds favor the latter. Instead of a parabolic spike and 80% crash, we could be looking at a series of rolling corrections that still leave Bitcoin higher at the end of the cycle. That's where risk management comes in. For retail investors listening to this, the temptation will always be to chase tops and panic at bottoms. But if this cycle is truly different, the playbook has to change too. Rather than thinking in terms of boom and bust, it might make more sense to think in terms of accumulation and patience. If the rally really lasts until 2027, There will be plenty of time to ride the waves. And here's a thought experiment. What if Bernstein's 200,000 target isn't even the ceiling? If sovereign adoption accelerates, if ETFs in Asia and the Middle East gain traction, if inflation returns and the dollar weakens, Bitcoin could climb even higher. At that point, we're no longer just talking about digital gold. We're talking about a parallel monetary system that sits alongside traditional finance. That's not something to dismiss lightly. So as we look ahead, remember this. The 2027 narrative isn't about blind optimism. It's about structural shifts. ETFs, institutions, macro conditions, sovereign interest. All of these are new ingredients in the recipe. And when you change the recipe, you can't expect the same meal. The halving still matters, but it's no longer the only driver. So now let's deal with the part nobody likes to talk about, the risks. Because no matter how bullish the outlook, Bitcoin is still volatile, still experimental, and still vulnerable to shocks. Regulation remains the #1 threat. Governments are warming up to crypto, but that doesn't mean smooth sailing. The same institutions that embrace Bitcoin ETFs could turn hostile if volatility or scandals spill over into traditional finance. A sudden policy shift, a harsh new tax, or even a ban in a major market could slow momentum. Then there are the black swans. Hacks, major exchange failures, catastrophic bugs in the code. They're unlikely, but not impossible. We've seen it before. Mt. Gox FTX. Events that seemed unthinkable until they happened. If one of those hits during this cycle, confidence could take a hit even if institutions are holding steady. And don't overlook energy. Bitcoin's proof-of-work model is powerful, but it consumes resources. As the world leans harder into climate targets, energy debates around Bitcoin mining will return. That doesn't mean mining will stop, but it does mean the narrative could shift, and narratives matter. So what are the scenarios? The optimistic one is simple. ETFs keep pulling in capital. Institutions hold steady. Sovereigns begin accumulating, and Bitcoin grinds its way to 200,000 by 2027. Ethereum rallies alongside it. XRP benefits from regulatory clarity. Solana captures high beta flows, and the entire market matures into something that looks more like a parallel financial system than a speculative playground. The cautious scenario is more modest. Bitcoin rallies higher but faces rolling corrections. Maybe we see 150,000 by 2026, then sideways action before eventually touching Bernstein's 200,000 target. The ride is longer and slower, but still historic. The bearish case is that history repeats. Bitcoin surges to new highs, maybe even past 150, but then greed and leverage get out of hand. The halving cycle asserts itself, momentum collapses, and by 2026 we're back in a painful bear market. It's the story we've seen before. Different players, same psychology. Which path plays out will depend on forces bigger than any of us. Interest rates, inflation, geopolitics, institutional appetite. But here's the truth. The idea that Bitcoin could peak in 2027 isn't crazy anymore. It's on the table. It's being modeled, debated, and taken seriously by analysts who once dismissed Bitcoin as a fad. That alone tells you how far we've come. So let me leave you with this thought. The next 2 years are not just about charts and price targets. They're about the evolution of Bitcoin from a speculative asset into something that institutions and maybe even governments treat as core. If that shift holds, the cycle math changes forever. And now it's over to you. Do you believe this rally can stretch into 2027, maybe even hitting 200,000? Or do you think history will repeat and the crash is inevitable? Drop your thoughts in the comments. I want to hear your take, bullish or bearish. This has been your Deep Dive Crypto Daily Roundup. Bitcoin is holding above 112,000, Ethereum steady at 4,200. But the real story is the future. Thanks for tuning in. Like, follow, and comment below. We'll see you at the top.